Welcome back to the deep dive. Great to have you with us again. Now, this is the second part of our analysis looking into Torrent Pharma's recent acquisition. So if you haven't caught the first part yet, we really recommend watching that first. It'll help make sense of what we're discussing today. Because today we're really getting into the nitty-gritty, how this acquisition is strategically set up to boost Torrent's position in the Indian pharma market. We'll be unpacking the finances, the impacts we expect, and, the big strategic bets Torrent is placing here. Think of it as trying to figure out Torrent Pharma's big chess move in what's a really competitive field.
Exactly. And we're going on a bit of a journey through the numbers today. But it's really important to see these aren't just abstract figures. They tell a vital story about Torrent's vision. It shows how the valuation, the way it's funded, and the long-term goals, well, they're all deeply connected.
Okay, let's start there then. Let's unpack Torrent's opening move, the valuation, the deal pricing. Our analysis called it sweetly priced. What does that actually mean for Torrent? Why is it seen as attractive right off the bat?
Well, sweetly priced. It basically suggests Torrent feels they got a really good deal on JB Pharma, maybe seeing value that others perhaps overlooked or, underestimated. To put some numbers on it, Torrent is starting by acquiring a 49.2% stake in JB Pharma. This is coming from KKR and some other key shareholders. And the price for this initial chunk, it's INR 1,600 per share, which works out to roughly INR 119.2 billion in total.
Right. So just under half of JB Pharma for almost INR 120 billion. But our analysis also mentioned a mandatory open offer that kicks in after this first stake, right? How does that fit? Is the price the same?
That's right. Yeah. After getting that initial stake, Torrent has to make what's called a mandatory open offer. This is to potentially buy up to another 26% of JB Pharma. And for this offer, the price per share is actually a little bit higher. It's INR 1,639.118. It's pretty standard, a regulatory thing to give other shareholders a chance to sell out if they want to.
Okay, got it. Now let's talk valuation multiples. At that initial INR 1,600 price, our analysis flagged 17x FY27E EV EBITDA and 28x PE. Now, for those of us not living in financial reports, what do these numbers really tell us? What kind of future is Torrent buying into here?
Yeah, these metrics are super important. So 17x FY27E EV EBITDA, basically, it means Torrent is paying 17 times JB Pharma's projected core operating profit for the fiscal year 2027. And that includes debt. Think of it like buying a business for 17 years worth of its annual operating cash flow, looking a few years out. A lower multiple like this, well, it often signals a more attractive deal for the buyer, suggests confidence in future earnings. And the 28x PE price to earnings, that tells us how much investors are paying for each rupee of JB Pharma's projected profit. Taken together, they suggest Torrent is making a calculated bet on strong future earnings growth.
Interesting. And our analysis also hinted at maybe a full merger later on. It suggested Torrent might offer 51 of its shares for every 100 JB Chemical shares. If they went for a full takeover, say 99% equity, that total deal value could jump way higher, right? Maybe around INR 245 billion. That sounds like more than just dipping a toe in.
Absolutely. That possibility signals a real long-term strategic intention, not just grabbing a minority stake. It's a much bigger commitment.
Wow, yeah, a massive commitment. Which brings us straight to the next big question. How are they paying for all this? Our analysis points heavily towards debt. So what are the financial implications of taking on, so much debt?
That's the crucial part. The initial INR 119.2 billion for the 49.2% stake, it's largely debt funded. That tells you right away, this is a bold move. It's going to significantly reshape Torrent's balance sheet. I mean, to put it in perspective, their borrowings are projected to basically quadruple, more than quadruple actually, from about INR 30,560 million in FY25 to a huge INR 135,560 million projected for FY26. It dips slightly in FY27, but yeah, the scale of that increase is immense.
Okay, quadrupling the debt, what does that actually do to Torrent's profitability and, the risk profile?
Right. Well, more debt means higher interest costs. Simple as that. Our analysis projects their interest expense will surge from around INR 2,520 million expected in FY25 up to nearly INR 9,479 million by FY27. That jump in interest payments, it's going to be a noticeable drag on their net profits, at least initially. And in terms of leverage, their net debt equity ratio is projected to pretty much double from 0.3x to 0.6x. So debt becomes a much bigger piece of their capital structure compared to equity. And maybe more importantly, their net debt EBITDA ratio that measures how many years of operating profit it takes to pay off net debt that's expected to climb from 0.6x up to 2.7x in FY26.
2.7 times. Is that high for a pharma company?
It's generally considered moderate to high, yeah.
Yeah.
It definitely signals increased financial risk in the short term. But, it seems like a calculated risk they believe they can manage.
Right, because management is saying they plan to pay it back pretty quickly, right? Something like 3-4 years using the combined cash flows. Is that realistic given how much debt we're talking about?
It's definitely aggressive, but the numbers suggest it's, calculated. If you look at the free cash flow, or FCF, our analysis projects it to be deeply negative in FY26, around minus INR 196 billion. That negative number just reflects the huge cash outlay for the acquisition itself that year. But, and this is the critical part, FCF is projected to recover strongly in FY27. Back up to over INR 40 billion. It's that quick rebound and cash generation from operations that supports their debt repayment plan. It shows the underlying strength they expect from the combined companies.
Okay, so it sounds like a classic trade-off then. A short-term financial hit, some pain now for what they hope is big growth down the road. Our analysis was pretty direct about this, saying the deal might be EBITDA accretive in FY27E, but, and this is key, EPS dilutive in the initial years. So for you listening, what does this EPS dilution really mean? And why would Torrent accept that dip?
That's a really key point. EPS, earnings per share, is basically the bottom line profit divided by the number of shares. It's projected to be revised down by roughly 8% in both FY26 and FY27 compared to what was expected before the deal. So what that means for you, the shareholder, is that each share you own will initially represent a slightly smaller piece of the combined company's net profit. It's a strategic sacrifice. Companies often do this in big acquisitions. They're betting the long-term gains will more than make up for this initial dip. And it's why we also see that projected slowdown in year-on-year EPS growth for a bit.
And what's causing this dilution? It seems like a few different things are contributing.
Yeah, there are three main drivers our analysis points to. First, amortization. When Torrent buys JB Pharma, especially paying a premium over its book value, it creates intangible assets, things like goodwill. Amortization is just the accounting process of gradually writing down the value of these intangibles over time. It's a non-cash expense, so it doesn't affect cash flow directly, but it does reduce reported net income. And our analysis shows a huge jump in these intangible assets, meaning significant amortization charges are coming.
Okay, amortization. What else?
Second, those big interest charges we just talked about. With so much debt taken on, those rising interest payments directly reduce the company's profits, leaving less net income for shareholders. And third, there's the potential for equity dilution. Remember that possible share swap? 51 Torrent shares for 100 JB shares.
Right.
If that happens down the line, it would increase the total number of Torrent shares out there. More shares mean that the same profit gets spread thinner, which further dilutes the earnings per share.
And this also hits their efficiency metrics, doesn't it? Our analysis showed return on capital employed, ROCE, and return on equity, ROE, are projected to drop quite a bit. What's that telling us?
You're absolutely right. ROCE, which measures how well a company uses all its capital, is projected to fall from nearly 19% down to around 10% by FY27. And similarly, ROE, showing profit generated from shareholder equity, is expected to decline from about 27% to maybe 13%. These drops really just reflect the immediate impact of having a much larger capital base and more debt. It affects Torrent's ability to generate returns right away. It's a short-term hit to efficiency, but again, the bet is the combined entity will eventually perform much stronger.
Okay, but here's where it gets interesting, right? Despite the dilution, the hit to returns, the long-term plan is for this deal to actually add value, to be value accretive. Our analysis specifically highlights it being EBITDA accretive in FY27E. So how does Torrent make that switch? How does it go from dilution to actually creating more value?
The key is really in the operational profitability. That's what EBITDA measures: earnings before interest, taxes, depreciation, and amortization. And our analysis projects a significant upward revision in the combined company's EBITDA. It's up a strong 7.3% for FY26, and then a really substantial 25.9% increase projected for FY27. This powerful growth in operating profit, that's the engine. That's what generates the cash needed to pay down the debt, and eventually it should boost net income and EPS again.
And where's that operational growth coming from? What's driving it?
Well, it's fundamentally based on very strong projected revenue growth for the combined company. Our analysis indicates net sales for FY26 are revised up almost 10%, and for FY27, it's a jump of over 34%. What's really crucial here, and we touched on this in part one, is that there's very little overlap in the actual medicines Torrent and JB Pharma sell.
Right.
So JB Pharma's revenues are largely just added on top. It directly boosts the total sales and therefore the operating profits. Plus, the projected EBITDA and gross profit margins look healthy. suggesting they expect good operational efficiency from the combined entity.
And it all seems to come back to that debt repayment plan. As they pay down that huge debt pile, the interest costs fall, which helps net income and EPS recover, and that net debt-EBITDA ratio starts looking healthier again, coming down from 2.7x towards, 1.8x.
Exactly. That rapid deleveraging is absolutely fundamental to unlocking the full value here. As the debt burden eases, the underlying financial strength really starts to shine through. And while our analysis is a bit cautious about immediate synergies, any cost savings or extra revenue they do achieve later on would obviously just add to that profitability further.
Okay, let's talk about those synergies then. That idea where, 1 + 1 = 3 somehow. Our analysis seemed a bit careful here, calling synergies a key monitorable. Why the caution? What does that mean?
Yeah, synergies, they basically refer to the extra benefits you get from combining businesses. Could be cost synergies like cutting duplicate roles or getting better purchasing power. Or revenue synergies, maybe cross-selling products to each other's customers. Now, Torrent's management sounds confident. They're referencing realizing acquisition synergies similar to past deals. But our analysis throws in a pretty important qualifier. It suggests that actually the previous management of JB Pharma had already cultivated most of the available synergies. So the easy wins, the low-hanging fruit, might already be gone.
That seems to be the implication, yes. It suggests JB Pharma might have already been running pretty efficiently under KKR. So finding big, easy cost cuts or quick revenue boosts might be harder for Torrent this time around. And that's probably why our analysis flags them as a key monitorable. Getting more synergies will likely need deeper, maybe more complex integration efforts.
So what are some of those specific challenges then? And why keep such a close eye on synergies if they might be limited? Well, apart from maybe fewer easy wins, there's always the complexity of integration itself. Merging different company cultures, IT systems, supply chains, sales teams, it's never straightforward. Friction here can delay or even reduce the benefits you expect. Another interesting thing our analysis notes. Management intends to share details on the quantum and type of synergies only post-acquiring a majority stake, which would be around Q3 of FY26.
Why wait so long?
Could be a few reasons. Maybe they're still doing the detailed work to figure out exactly what's achievable. Maybe they're being cautious given our analysis's point about existing efficiency. Or maybe it's just strategic, keeping plans close to the chest for now. And lastly, there's mention of a retention plan for key JB Pharma people. That's vital. You don't want key talent walking out the door because that could seriously harm any potential revenue synergies.
Makes sense. But even if they're challenging to get, those synergies are still pretty crucial for the overall profitability and ultimately justifying the price they paid, right?
Oh, absolutely. Even if they're incremental, every bit of synergy helps. It flows directly to the bottom line, improves profitability, and contributes to that future EPS growth Torrent is counting on. Without some synergies, making that sweetly priced valuation really pay off becomes harder. It's a really vital piece of the long-term picture.
Okay, let's shift focus slightly to the direct impact on Torrent's books. The balance sheet structure, how cash moves around after the deal. Our analysis mentioned some pretty dramatic changes there. What stands out?
The biggest, most striking change you'll see on the balance sheet is under total intangible assets. This number is projected to absolutely surge. It reflects the goodwill, basically the premium Torrent paid over the value of JB Pharma's tangible assets and other intangibles from the deal. It's a massive accounting entry. And consequently, the whole balance sheet just gets much bigger. Total assets are projected to almost triple between FY25 and FY26. You'll also see a noticeable jump in net fixed assets, which represents JB Pharma's factories, equipment, and so on.
And what about the cash flow? How does swallowing such a large acquisition affect the day-to-day movement of cash?
Well, there's a definite, though temporary, major impact. Our analysis shows a huge figure under capital work in progress fixed assets additions in FY26. That basically is the acquisition cost flowing out. As a result, as we mentioned earlier, Torrent's free cash flow is projected to be significantly negative that year. The company basically spends way more cash than it brings in operationally, just to fund the deal. Where does the cash come from? Well, you see a corresponding large inflow under cash flow from financing activities. That's mostly the new debt being issued. But, and this is the positive flip side, remember that strong FCF recovery projected for FY27. It shows the underlying cash generating power is expected to return quickly, enabling that crucial debt repayment to begin. So it's 1 year of massive investment outflow, then back to generating strong cash.
Wow. Okay, this has been an incredibly detailed deep dive. We've gone from the initial price tag right through to long-term vision. It really paints a picture of this acquisition as a major strategic long game for Torrent Pharma.
Absolutely. I think what our analysis really lays bare is that Torrent is making a very calculated strategic move here. They're accepting that initial financial dilution, they're taking on significant debt, all for a future where they see a much stronger market position in India, robust revenue growth, and ultimately enhanced operational profitability. But, the success really hinges on execution. Can they integrate JB Pharma smoothly? Can they stick to that aggressive debt repayment schedule? It leaves you, the listener, with a pretty big question, doesn't it? How do you weigh that balance between the immediate financial sacrifice and the potential for long-term strategic gain in these kinds of high-stakes corporate deals?
That is a fantastic question to think about. Thank you so much for walking us through all of that complexity, and thank you for joining us on this deep dive. Keep that curiosity going, and we'll catch you next time on the deep dive.